This lecture is about the quantity theory, which is the mainstay of our view at how economists view money. In the first lecture I said that money was an institution, in many ways mysterious institution, and so what we're doing is seeing how people interpreted it and how they wanted it managed. And one of the mainstays of this interpretation is precisely the quantity theory of money. I have a story to tell in this lecture, and that's the evolution from metallic monies, mainly based on gold, to monies that are managed, that are paper or fiat money. By fiat money we mean money made by voluntary, by will. And fiat money is the end of an evolution, because for many years, or for many centuries, societies wanted to have money which had a content that gave it value. And that slowly changed because it was discovered that one could have a monetary system where the value was due to the demand of people for a currency and a limited supply by central banks or whoever created money. So I'm going to tell a story which is moving from metallic money to the present day fiat money. Because it's a very long story, and there were many tries to have money that was not based on metal but based on paper or based on promises by the central bank. And that long story is the one I'm going to tell in the works of the economists that studied it, rather than in what actually happened, because this is not a lecture about, these are not lectures about economic history, they are lectures about intellectual history. And the move that we are studying is beautifully told by David Laidler in The Golden Age of the Quantity Theory, because as Laidler shows, economists came to understand that a properly functioning money was based on the quantity of money theory of the price level, to give it the full name. And what Laidler insists on is that people have usually said that we have given up the gold standard because of the First World War, but what Laidler is saying is that it was prepared in the scientific discussions that we had in the second part of the 19th century. It was prepared, and when the First World War happened, then the move towards paper money or money fiat, according to will, was made. Now, another thing that I'm going to do in this lecture is to bring together the evolution of money demand and money supply. It's now time to shift our attention to the money market as a whole and its role in the real economy. So for a moment we're going to return to the moment when money demand and money supply were combined in monetary thought. And what was crucial in discovering this combination was the increase in the price level caused by the arrival of gold and mainly silver from the Indies, as we call them, the Spanish call them the Indies, or Latin America today. To give some explanation, historical allusion to people who discovered that very far back, the first one I want to study is a cleric called Martin de Spilqueta, who in 1556, in his edition of his Manual of Confessors, gave reasons for price rises. The Manual of Confessors was important because in confession, merchants used to ask the confessor, the priest, whether they had committed a sin when they sold something for more than they had bought it. And this difference between the price as when you buy it and the price when you sell it, many considered an unacceptable profit. But before doing that, Azpilicueta said, if there is an inflation, then it's normal that part of the increase in price when you sell a thing may be due to the effects of money arriving in the economy. And he gave reasons for price rises. He said, one, what makes money go up or down is there being a great lack or need or abundance of money. It is worth more when there is a great lack of it, and then when there is great abundance, and then money has low value. Two, all merchandise has become expensive because if the great need and the small quantity, if there's a great need and small quantity, then money is a saleable and exchangeable thing, and it is a merchandise, and therefore it obeys that law. And then he added something which is very extraordinary for the time. He was considering explaining the phenomenon of price rises, everything being equal, other things being equal, as he said in Spanish, siéndolo al igual. And if everything is equal, then in the lands where there's great lack of money, all saleable things, and even the hands of labor, and labors of men are given for less money than where there is abundance of it. As happened in Spain, as happened in Spain after the discovery of the Indies, covered it with gold and silver. Then there was another friar, Tomás de Mercado, who dealt with the effects of the abundance of silver on the exchange rate too. So the quantity theory not only explains the effect of the abundance of supply of money on the price level, but also the effect of an increase in the supply of money on the exchange rate. And what Tomás de Mercado said, he wrote a book on the ethics of merchants and financiers. In the second edition, he dealt with the effect on prices of precious metals come from the Indies and on the rate of exchange. And this I will study in the third lecture. Jean Baudin is usually a Frenchman who usually credited with discovering the quantity theory of money, but he was later than Azpilicueta, and he was less complete than Tomás de Mercado, who studied the effect of the supply of money on the exchange rate. Now here we have the currency that was produced in the Indies and covered the whole world. This is the piece of 8 that that was so famous that people wanted to get off a bit. It's for 8 reals, and it's a beautiful piece in silver of the year 1770, but of course we had pieces of 8 earlier than that. And here I've added the mountain of Potosi. A mountain of Potosi was a mountain of silver, for goodness sake. There was so much silver there, and that we, the Cantillon, had discovered is that silver was not held in a mineral that you had to separate by chemicals. What you had is an addition of silver and stones, and the way to get the silver was to add mercury to broken up minerals, and the mercury displaced the silver was free, and that could be taken out and then made into coined into silver coins. Now, as I say, my story is how slowly we, the humanity, discovered that we could have a currency that was not based on an amount of gold or an amount of silver. And so there were different attempts to have paper money. And those attempts, especially in the beginning, it just didn't work. And people didn't put their confidence in paper money. And there were disaster stories. The most important one is that of John Law, a Scottish financier who first tried to convince the Scots that they could have paper money. The Scots are canny in matters of money. They didn't pay attention to him. The Scottish Parliament said no, but then he went over to France, and there he created a bank, the Banque Générale Privée, that Banque Générale Privée, created in 1716, issued paper notes for silver. And this, he was able to convince the authorities of France, John Law, that one should turn this Banque Générale Privée into the Bank of France, Banque Royale de France. And they issued paper notes for silver, and then they accounted money in a currency that didn't exist. It was a currency that was invented, the livre tournois. And so what he did is, once people deposited silver in the Banque Royale and got paper money in exchange, he used 50% of that he kept in the bank. So that if people wanted to get the money, their metallic money out, they could get it. The other 50% he invested in an adventure in Mississippi, which didn't go well, and then he bought. He also got the permission to charge, to farm the taxes. That is, to be the one. This bank would get the taxes from the people and turn it over to the exchequer, and then finally he purchased the tobacco monopoly, and he purchased, or tried to purchase, the whole national debt of the French kingdom. So there was a huge speculation, but the system in the end failed and disappeared. Here we have a paper money issued by the Banque Royale, promising the bearer 100 livres tournois, and it was signed by the different authorities there. So this was the paper they got, the people, depositors got against the silver they deposited in the bank, but in the end all was lost. Now, he had a friend, Mr. Law, called Richard Cantillon. He was successful, but less than honest banker, and he believed that you couldn't have paper money, that the only money that people would trust would be silver and gold. And so what he did is bet on the silver, and what he did was to use the money that people gave them against these paper monies to buy shares in the market, shares of this company that had been founded in the Mississippi. And then they got loans against the deposit of these shares, the nobility and bourgeoisie of France. And then immediately he got the deposit, he sold these shares on the market at a high price. And then when the market foundered and all the shares were worth nothing, he asked the people who had deposited the shares as a guarantee for a loan to give back the loan, and he gave them back the shares. And so people were very angry, didn't like him at all, took him to court, different people. In the end, it is not known how he ended, because what the rumor had been that his cook had killed him and then burnt the house where his body was. But then somebody appeared in the Dutch West Indies who looked like Cantillon, and it is believed now that he killed the cook. He tried to burn the house down and took his money to the Dutch West Indies and disappeared in the primeval forest. So these people, these two first attempts at A, having paper money, and B, trying to function with it, were tried by two people who were not very reliable. In fact, Mr. John Law was condemned to death once for having killed an irate husband in a duel, and then he was got out of prison by one of his lover ladies, and so escaped to France and became a banker there. Not examples to be imitated. And here we have the two, John Law on the left and Richard Cantillon on the right. Now, there was another byway through which the idea of a paper money, of a money that was worth more on the face of it than the contents, because paper money says, here's £10, and those £10, say, have them here. Here I have £10. These £10 say that the governor says, I promise to pay the bearer on demand the sum of £10. Right? So you have these £10. Well, what will they do when you take them to the Bank of England? They'll give you two £5 notes. They won't give you any gold or anything. So that's a declaration which is a remnant of past times. And so the question of the banknote is that the value of it on the face of it, you can buy for £10 of goods around the corner. The value is much higher than the cost of making this money, the cost of printing this paper. The difference between the two is again that the issuer gets in the difference between the cost of making the money and then the value of it on the market, and that's called seigniorage, because the seigneur, the lord, was able to get this. Now, the question of money, paper money or fiat money is always, on the face of it, it's worth more than what it can buy in the market. And this was a problem caused by small change, because if you have small change, that is silver pennies or silver 5 pennies, to be able to do your daily purchases and so on, if those pennies, those small change, have a content which may be of higher value than what it says stamped on it, and you have a 5 penny currency coin, that 5 penny coin is made of silver, and if silver suddenly becomes more expensive in the market, you will either clip this one, or you will take it to make it into a silver bar, and take it to the market and get more. So having small change whose value is based on metallic content is dangerous. That small change will disappear because the metallic content suddenly is worth more than the face. And the metallic, that will leave the country without small change to do the daily purchases. And it was not until it was discovered that with small change you had to have the content of the coin much smaller than the value of the face of it, and secondly, not coin so many of these small change coins so that they affected prices, and they caused an inflation. And here you have then that small change is in a certain sense a fiat money, because the value of it is made by the authority and not made by what it has inside. And this is precisely what happens with paper money. And since we're going towards paper money, we're telling this story. Here we have one of the byways that made people discover slowly that you can have the face value of a bill or the face value of a coin being much higher than its content. Now, the gold standard has been the main metallic money system that one had in the world, especially in Great Britain and also in other parts of Europe. And the gold standard was was set by Newton, the great astronomer, who in 1717 was the master of the mint, and he lowered the value of gold with respect to silver. That is, the value of gold in a gold coin was lower than the face value of this coin. And this meant that people, so gold was overvalued and silver was undervalued, and as it was undervalued, silver disappeared. People melted it or took it to France or did whatever they want to get the value that was inside. So the gold standard is based on an excess valuation of the metal. Here again we have the same thing, which is that the face value of the coin is greater than the content. And so in a curious way, the gold standard is a way of having fiat money, having money that is higher value than its content. So there was what we call Gresham's law. Gresham's law tells you what happens to the currency in a metal that is undervalued. People will melt it and take it where they'll get some money, more money for it. And therefore that's how, by fixing gold too high in 1717, Newton made for gold being the base of the currency. He fixed it at £3, 17 shillings, 5.5 pennies in 1717. Then the gold standard period went on from 1717. Legally, it was a matter of habit that the Bank of England gave you that a gold sovereign for £3, 17 shillings, 5.5 pennies in paper, and vice versa. But then after 1819 it became official. It became legal tender, as it said. It wasn't de facto anymore, but it was legal tender in the sense that people had to accept that money, both the paper and the coins that they represented, accepted in payment for debts. And this went on at this price until in 1931 England or Britain left, the United Kingdom left the gold standard and freed money from the value of its content, or the declared value of its content, these £3, 17 shillings, 10.5 pennies. For a time it had been suspended from 1798 to 1819 during the Napoleonic Wars, but then England or the United Kingdom went back to gold. And you had also these changes in the US dollar. It was fixed to gold. The dollar was fixed to gold after 1834. There was a great inflation of greenbacks. Greenbacks were in fact paper money. And they had, as we see today on the dollar bills, they had a face in front. And they also had "In God We Trust" and so on. But they were green. And the greenbacks were the ones that the currency that ran during the Civil War in the north. then they went back to gold. And from 1870 to 75, many European countries also moved to the gold standard, importantly Germany and France, up to the First World War in 1914, when that was suspended. There was an attempt to return to the gold standard in between the two wars, but that didn't go well. So how did the gold standard function in the UK? In the UK, the gold standard rules were very strictly kept, not so much in France or in Germany. In the UK, the gold standard rules were very strictly kept. There was free exchange at the gold window in the bank, at the Bank of England. So if you brought the amount that I said before of £3, 17 shillings and 10.5 pence, you got an ounce of gold for it. So that there was free exchange at the gold window. There was no attempt to stop people from getting gold out or putting it into the Bank of England. Then, if the price of gold in England went up because it became scarce, then this would lead people to bring gold over from the continent. But of course, the scarcity had to influence the price of gold would have to go up until it was above the pounds that were the amount I said, plus the cost of transport and insurance. You had to bring the gold physically, so that had a cost. So there are two gold points: the cost of transporting and insuring when you brought gold in from the continent, or when you paid it back to the continent because it was too high in the UK. Then the Bank of England not only was influenced by the fact that if gold came into the country according to the quantity theory of money, prices would go up in the end. What they did was forestall that, see that gold was coming in, and they increased the bank rate, the discount rate. That is, they made, if gold was coming in and prices would then go up, what they did was they made the bank rate higher so that people stopped making so much business. The boom was quietened, and there wouldn't be an effect of, there wouldn't be so much gold coming into the country and an effect on prices. So there was a rule that there was no sterilization. That means that the central bank could not accumulate gold to avoid, when it came in from the continent, accumulate gold to avoid prices going up, which is what the US and the French did, and the Germans too, after 1875. So you also had country banks. The country banks used Bank of England notes, calls on London correspondence for their reserve, and slowly during the 19th century the Bank of England was accepted as lender of the last resort. This didn't mean that financial crisis did not happen anymore. In fact, one of the curious things is that there was a belief that once you had a gold standard and the value of paper money was fixed to the value of gold, why should there be crisis? Why should people start worrying about the situation of their business or their bank? It was believed that if you had this fixed, there would be no crisis. But my goodness, there were crises. Crisis in 1825, in 1831, in 1837, I'll go on with the story, 1842, 48, 56, 65. So there was this problem that despite the gold standard, one had these crises. And so slowly the Bank of England accepted its role of lender of last resort. Whatever the cause for crisis, for financial crisis, if there was one, people got very worried, tried to get as much coins, as much metallic money as they could, and that made for metallic money mostly disappearing and problems with the supply of money. So the Bank of England had to go into the market and flood it with money so that the worry of caused by the financial crisis disappeared. All right, so there was a lot of discussion of paper money under the gold standard. The person who first broached this, who first spoke of the quantity theory of money, he didn't call it that way, but he was the first who really made people aware of it, was David Hume in his essay on money in 1752. He didn't like paper money. He thought it was counterfeit money. He wanted people to have metallic money in gold and perhaps some small change too in silver. But he thought that counterfeit money, that is paper money, was dangerous. And he based himself on the financial crisis that you had in the 18th century too. For example, in 1772, there were people clamoring for cash. When there's a crisis, people want to be liquid, just in case those that owe them money don't pay them, and that they or she have to pay money out. So they want to be liquid, and so they don't want paper, they want real good coins. And so Adam Smith, on the contrary, was in favor of paper money, and he thought that banks were useful because they gave credit to businesses, and it was important that they did not overissue, making paper money too abundant. During the wars between France and the UK, well, in fact, it was wars between lots of countries in Europe against the French and against mainly Napoleon. There were naturally money problems, mainly caused by the fact that the English sent money to the continent to pay for the armies that should resist Napoleon. Didn't resist him because he was a wonderful general, not a very good man in so many ways, but he was a wonderful general and beat them all hollow, except in 1514 when he was beaten at Waterloo. But the rest, he always won. And so what happened is that it seemed very difficult to maintain the convertibility of sterling paper into gold. And there was a suspension of convertibility from 1797 to 1819. And after 1808, up to 1808, from 1797, the value of gold and paper maintained, but after 1808 there was a spike in the value of gold, and so there was what we would call an inflation. And so the Bullion Committee was convened in 1810 to discuss what had caused that inflation, and whether it was sending money abroad to the Allies and bad crops that forced the importation of corn for gold, or whether it was an excessive supply of paper money by the Bank of England. And so they set up this committee to decide whether there should be a rule at the Bank of England stopping it from issuing too much money. In 1802, while the committee was sitting, before the committee was sitting, and Henry Thornton wrote a book on paper credit, that he became a member then of the Bullion Committee, and he believed that the depreciation after 1808 was due to excessive issue of pounds by the Bank of England. So there were a number of people who thought that no, that it was sending money abroad and the back crops, and in any case an excessive supply of paper currency would lead to people taking it back to the bank once there was convertibility, taking it back to the bank to get real money, metallic money. And so there was a natural stop to excessive issue and to inflation. David Ricardo was a very influential economist on questions of money. And he made two proposals, which I will study in my fourth lecture: a proposal for an economical and secure currency, and then he proposed a plan for the establishment of a national bank. In the proposal, it was the 1816 proposal was just when people were beginning to discuss going back to convertibility or paper into gold, because Napoleon had been defeated in 1815. And so that he proposed the following, that when the country went back to convertibility to gold, then it should not be by returning to gold coins. They were expensive. There were no gold mines in the UK, and therefore exports had to be given to gold producing countries so that gold would come to the UK. And that was, of course, expensive. You had to pay with goods for gold. And he said yes, but he thought yes, but it was important that there should be convertibility. It was important that there was a limit to the amount of paper currency the Bank of England could issue, or the country banks could issue, and that was under the gold standard. There was this limit, because in the end people could go to the gold window and get coins. But then he said coins are expensive. Let's have a different system whereby people all work on paper, but there was a possibility for rich people to take £500 of paper and get a gold ingot. And that, of course, would maintain the value of paper with respect to gold. And so there would be, after, as Ricardo said, no currency in gold, but what there would be is the possibility of getting gold ingots for paper money when it was a big sum. And so that would save the country the need to have gold coins that were jolly expensive. Then there was in 1817 to 19, there was a crisis, a financial crisis in England, because the return to gold was decided on the parity, on the same value as it had since Newton. The trouble is that there had been an inflation in the middle. So to be able to return to convertibility in terms of the price set by Newton, you had to have a deflation. And that deflation would cause unemployment, and companies would be going bankrupt, and so on. So what he wanted, then he proposed, and this was published after his death in 1824, a plan for the establishment of a national bank. He wanted to take away, or to take out of the hands of the Bank of England, take the issue of currency. That should not be in the hands of a private banker, because the temptation to overissue for a time was too strong. So he proposed that the Bank of England should be divided into two establishments, one a normal bank giving credit, and the other one the Bank of Issue. But that Bank of Issue should be nationalized. So Ricardo, the arch-liberal of that time, proposed the nationalization of the creation of money by a number of commissioners, and so that those commissioners would be ready to do what the bank was doing before, is exchange gold for paper and paper for gold at a fixed rate. That would maintain the value of the paper, but it would separate the creation of money from the lending of money. And the accusation was that the Bank of England printed the money and then lent it. Printed too much money because they made money on it. And so that would have to be taken away, taken out of the hands of the central bank. When I first studied Ricardo, I didn't expect him to nationalize the issue bank, but there you are. One always has surprises in the history of thought. After the resumption of cash payments in 1819, when the Napoleonic Wars were finished, after Waterloo, there was this idea that by having the convertibility of the paper money into gold ready there would be no financial crisis. Because the moment that there was a need for lots of liquidity, because companies were going bankrupt and banks were also failing, you could always go to the Bank of England with your paper money and get coins out, and so you had the liquidity. So why should there be financial crisis, is what people thought, and Ricardo thought, especially after, as he expected, there would be commissioners issuing the money, not doing so for their own benefit. Now, far from that, as I said before, there were many crises, and those crises were repeated, 7-6 years intervals. And this gave rise to a discussion, first about whether the Bank of England should still be trusted with issuing money, and secondly, whether it should be flexible in times of crisis. That if there was a crisis, there would be lots of money, the market would be flooded with Bank of England money, and so people didn't feel that they wanted, that they needed lots of liquidity. And that discussion was between two schools, the banking school and the currency school. The currency school was very strict about how much money could be printed by the Bank of England or by the National Bank, as Ricardo had wanted, while the banking school said one should be flexible. The Bank of England should be flexible, and if there was a crisis, they should indeed create more money. And there are two kinds of problems. The banking school had the problem that they said there were two kinds of loss of reserves by the bank. One was when the reserves went abroad because of the deficit in the balance of payments, and two is when the reserves were asked by the people inside because there was a need for more liquidity. So in 1844, the government, led by Peel, decided that they had to reinforce the solidity of the currency by forcing the Bank of England not to issue too much money. And so in that Bank Charter Act, they divided the Bank of England into two parts. One was the banking part, the lending, the credit part, and the other would be the issuing part. And the bank was not allowed then to issue more notes than there were in the country, except the following. If gold came in, they could print notes. If gold went out of their reserves, they had to take the notes back. And so the division of the Bank of England into two parts by the Bank Charter Act sort of reinforced the Ricardian view that that if you had good control of the issue of money, then there would be no danger that there would be financial crisis. This was made an act of Parliament, but in the end, crises went on, and you still had them after 1844. So that was a big surprise and conundrum for people in general. And secondly, slowly the Bank of England, after 1825, but mainly in the 50s, started acting as the lender of last resort, which is when there is a crisis, which there shouldn't be, but there was, and when there is a crisis, then they had to flood the market with money. So John Stuart Mill was especially interesting on these points. Though he was a disciple of Ricardo, he modified the views of Ricardo on money. The 1825 crisis, financial crisis, which caught him at the age of 19, he was a good economist by then already, the financial crisis surprised him as everybody. It was a very deep financial crisis, and they didn't know what was happening. Haven't we gone back to the gold standard? Why should there be a crisis of liquidity? If people needed liquidity, they should take the notes to the bank and get the money out. So why was that? And what he wrote, the young Mill, in 1828, but then published in 1843, was that one of the mainstays of classical economics didn't function automatically, and that is called the Say's law. Jean-Baptiste Say had explained that whatever you produce will find a market if prices are flexible. Therefore, there would be no overproduction, which is what really happened in these crises. Goods that nobody wanted to buy. And so there could be no overproduction, said Say, because whenever you produce something, you created the resources by paying wages and so on. You created the resources for people to buy up what was produced. But the young men said, yes, but this doesn't work immediately when you have money, because with money you can sell your goods and not buy, and keep the money in a hoard, and that would make the amount of demand for your production lower than the production, and cause the sort of financial crisis that we saw. And so he moved towards the banking school, wanting the central bank to be flexible and suspend from time to time, if necessary, the 1844 Peel Act while there was a financial crisis. Now here we go into the study of the quantity theory by the different economists. Alfred Marshall, who didn't publish on money until the 20th century, did write on money, no less in 1871. He wrote an essay on money, which he never published. He did publish something on money in 1879, but the definition of the quantity theory, as we know it, was already in Marshall, but people didn't know quite about it enough. So what we find in this essay of 1871 is that he defined the different points of the quantity theory so that as he defined them, it's been accepted, and that's how the quantity theory works. Now, there were 5 core propositions in his essay on money, and in general on the quantity theory as defined by Marshall. First, there was a proportionality, the same proportionality of money and prices. If money doubled, prices would double. If it trebled, prices would treble. Secondly, in the famous quantity theory formulation or identity that MV equal PY, MV means money, the quantity of money multiplied by its velocity would be equal by the price level and the product of goods, Y. Now, what he said is, what he laid down was that the causality arrow went from money to prices and not back from prices to money. And so there was equiproportionality of money and prices, and also money to price causality. Then he went on to another point, 3, was that money was neutral. Another point of Marshall on the quantity theory was that money really in the end had little to do with the real economy. Money was exogenous, it came from the outside. And so that number 5, that meant that there was a dichotomy or separation between the relative prices that governed the market every day and the absolute price level. And so that for him and for the quantity theorists, money was separate from the real economy after a time, because it took time to have this separation. So these 5 points of Marshall on the quantity theory became the orthodox view of seeing the quantity theory. So Irving Fisher, in The Purchasing Power of Money, explained what interest rates were, and especially what he did was proposed a way of measuring the general price level to distinguish it from relative prices. And the way of measuring the general price level was to have index numbers. Those index numbers will allow economists to know what all prices were doing at the same time. Now, John Maynard Keynes, who was a disciple of Marshall, worked with him, didn't accept the quantity theory in 1936 in his general theory of 1936. He maintained that the quantity theory, that is, the equiproportionality of changes of money with prices, double money, double prices, and also the separation between money, the money economy and the real economy only worked if the economy was in full employment. And therefore, if there was unemployment of resources or unemployment of workers, then you could increase the quantity of money without affecting the general level of prices, because there would be more employment and higher wages, and not more employment mainly of resources, and that would not show on prices. So for Keynes, inflation only happened when there was full employment. When there's no full employment, you didn't have inflation that way. Now, Friedman criticized Keynes by saying that the demand for money was stable, and it wasn't, that demand for money wasn't influenced by the amount of money that you created. So if too much money was issued, then people would try to get rid of that money, and they got rid of it by buying things, and therefore making prices go up. And the idea that your demand for money was a stable proportion of your income was something that gave a very different theory of inflation. The theory of inflation was, for Friedman, inflation is always and everywhere a monetary phenomenon, in the sense that it can only be produced by a more rapid increase in the quantity of money than in output, while for Keynes the inflation was really non-monetary, in the sense that you had inflation not when you increase money, because if there was unemployment there would be no increase in prices, but only when the economy was fully employed, then you have inflation. And also that inflation was an indication of the employment level in the economy. So, as I said, the classics wanted to separate the money economy and the real economy. It's called the classical dichotomy, and that classical dichotomy implied that there was neutrality of money. Money was neutral with respect to actual production, and that dichotomy, classical dichotomy, has been discussed and rejected by many economists. Now, the quantity theory, which is what we've been studying, is really rejected by a number of people. And there are monetary heresies. One of them is called the Phillips curve, which means that if inflation will help you to reduce unemployment. That means that there's no dichotomy between the money economy and the real economy. You increase money, you create an inflation, and you create more employment. The Phillips curve, as it's called, is a way of believing that you can make the economy grow by creating more money. And then there's the modern monetary theory today, whereby the new monetary theorists are saying that while there's no high inflation, the government can create debt, issue it and spend it on roads, on education or whatever, but it has to be debt that is issued for domestic consumption within the country and not abroad, because having lots of debt abroad can be very dangerous. And this way of looking at the quantity theory of money is one that the classics would reject.